It does take us to our talk of the tape. What could be the most volatile stretch of the year for stocks and how to play these next couple of weeks? Let's ask Dan Greenhaus, Solus Alternative Asset Management's chief strategist, with us once again at Post 9. It's good to see you again. Is that what we should prepare for? What could be the most volatile couple of weeks? You got mega cap earnings, and then, of course, 2 weeks from tomorrow, you got the election.
Yeah, listen, we should probably have a little more volatility, although it bears mentioning that the VIX is, call it 18 right now, which considering the stock market's making a new high, is already a fairly high level. So already you have some volatility that belies some of the historical analogies, if you will. So
I have most commentary out there today is that we're still positive, right? We're still in the uptrend. Tony Pescarello at Goldman, baseline view positive given the inherently friendly interplay between growth and the Fed. You cut out all the noise. Is that what you distill it down to like he did?
Yeah. I think it's really that simple. Earnings are going up, obviously at a slower pace. The economy is expanding at a somewhat slower pace, although still robust. And when you put those two things together, that type of an environment is traditionally positive for equities. And the better question is not, should the stock market be going up? Why is the stock market going up? The question is how best to play that, what sector, what asset class, et cetera, et cetera.
Well, I mean, you say earnings are going up, but then you sort of couch it a little bit with at a slower pace, yep, which is fair. I mean, that's estimates have definitely come down. But multiples are not really expanding at a slower pace. So you got the valuation of the market like 22.5 times, yep, which is historically rich. But if you're telling me that earnings are growing at a slower pace, the rubber meets the road somewhere between that, doesn't it?
Well, the issue I have with the valuation argument, listen, clearly 20, 21, 22 times forward earnings is more highly valued than the equity market has traditionally been over time outside of a couple of episodes. So there's no doubt about that. And no one should dismiss that. The problem I have with
Except you right now.
Well, no, I'm not. No, the problem I have with it is I'm just not sure what I'm supposed to do with that. And what I mean by that is there was a point in time in the 2010s where people were telling me 16, 17, 18 times is historically rich, and I wasn't sure what to do with it then either. Valuation is one of those things that are one of those market observations totally worth being aware of, totally worth making, but outside of the extremes, call it single digits, 8, 9 times, or extremely high levels, call it 29, 30, 31, 32 times. In the middle there, it's really difficult to ascertain which one of those metrics is worse than the other. Is 20 rich? Is 22 rich? Is 24 rich? You don't really know without the benefit of hindsight.
I think the point of discussing it and asking the question is to debate/discuss whether people who are still sitting in a fair amount of cash should get into this market now or wait because it's too expensive at a time where earnings expectations, though high, are coming in. And there are some calls that returns over the next few years are going to be kind of meager.
Yeah, so I saw the return thing, but the return argument. But before we get to that, do we know that there are people sitting in large amounts of cash? We've been in a bull market, obviously not uninterrupted, for 15 years now or so. I'm rounding. Obviously, we had COVID in the middle, and that scared some people out. But I don't really know that there's a lot of people sitting in large amounts of cash for fear of the market, if you will.
Well, I mean, there was a lot of money, and the numbers bear it out. I mean, over the last few years, because of what the Fed was doing with interest rates, there's obviously was a lot of money sitting in money markets.
There's $6+ trillion sitting in money market funds.
Okay,
fine.
That's a lot of money.
That's a lot of money. You need to scale that for something. And when you normalize that for, say, the size of the equity market, it's not particularly egregious. The equity market is 51 trillion in size right now. Put that way, 6 trillion, not that much. But part B of that conversation is, yes, there's a lot of cash, but does that mean there are a lot of investors sitting in large percentages of cash themselves? No. I'm not sure that's the case.
But I think people are asking the question of, should I become more invested at record highs? We're on a 6-week winning streak.
Our friend
Joe, the longest of the whole year.
Listen, I don't know if today, tomorrow is a momentary pause, but I'll borrow a phrase from our friend Joe Terranova. You're not supposed to buy low, sell high. You're supposed to buy high and sell higher. And that's an oversimplification and sort of a snide remark.
No, it was a title of his book. We get it. But
you're welcome, Joe.
Thank you very much.